Welcome everyone, I am really excited you're here. This week we're going to be going over Cooper Standard, a stock that I believe has potential to make millionaires. Stick around as I go over why this company's recent turnaround could be a game changer for your portfolio. And after that, by popular demand, I will give an update on Daqo New Energy and answer questions. So with that, let's jump right in. First off, what is Cooper Standard? Cooper Standard designs, manufactures, and sells sealing, fuel, and brake delivery, fluid transfer, and anti-vibration systems to car manufacturers around the world. They are a global supplier here. In 2023, they got 51% of their revenue from sealing systems, 26% from the fuel brake delivery systems, 19% from fluid transfer systems, and 4% from others. Looking at this company, one of the most important pieces to understand first is what industry are they in and what is the industry outlook. Because no matter how good the management is, if the industry they're in is going down, it's not going to perform that well. So the auto industry isn't going anywhere anytime soon, as you could have probably guessed, and will continue to increase worldwide at about the rate of GDP plus a small percentage. This was reflected in the average of 7 different forecasts at 4.9% growth over the next several years. Not fantastic, not phenomenal growth, but it is going to be growing and it's respectable. So it's an industry that I'm willing to look at. Next, moving on to management. How is the management actually performing just generally here? We're going to go over what I found to be the most important. Management, first off, their shares outstanding over the past 13 years since 2011, their shares outstanding have actually dropped just about 10% or a little less than 1% per year, which lets me know this management respects shareholders. During the earnings calls as well, as I mentioned, this is a cyclical company, and they talk extensively about cost cutting. In 2023, they delivered $56 million in cost savings, which is on top of the $185 in sustainable cost reductions they created in 2022 and 2021. With peak free cash flow in 2018 of $201 million, if that full savings that I mentioned were to fall to free cash flow, that would mean surpassing their previous peak by 130%. This lets me know this management has a great focus on cost cutting, and in a business that's really cyclical, that has very high peaks and low lows, this is a great thing to have because it allows them to weather storms, and that's going to be important for a conversation here in just a second. On their public communications as well, the management is clear and plain with excellent focus on reducing costs while being upfront about losing money or changes that happen. They seem to do very well at this and just communicate overall effectively. And it's something that I really like to look for in any management that I'm looking at after I've identified an industry that I think will be okay and growing going forward. So let's get into really the things that have pushed the company to a low valuation today. This company, along with a drop in revenue, had some urgent solvency issues with rising debt and free cash flow turning negative. And you're going to see that in these charts here below. So since the early 2000s, you guys can see kind of the cyclical nature, having that dip around 2008, and then having a steady rise until 2018 where they hit their peak, and then falling off from there and kind of starting this rise back up. But this was during the time right here, around 2020 and a little bit on, where things got really ugly for the company. Their free cash flow, as you guys can see, 2016, around there was their peak before falling off and being significantly negative, sitting around negative 200 million in free cash flow. And their long-term debt during this time was rising. You can see 2018, 2020 took a fairly substantial jump. When you've got a company like this that's losing a lot of cash every quarter and taking on more debt, solvency issues are going to obviously be an area of concern. So that's why this company was trading down to incredibly low levels. People actually thought they were going to be going completely bankrupt. When you look at their debt obligations that they have, and this, I pulled this from their annual 2023 report, you can see their total debt at the end of 2023 sat about $1.1 billion, just above. In the next 12 months, they had about 48 million worth of debt coming due. 1 to 3 years, about 42 million coming due. And 3 to 5 years, they had the majority of over $1 billion coming due in that time frame. People were very concerned that this company was not going to be able to make these payments and potentially continue losing money, which is cause for concern for any company here. So to address these issues, let's go back and look at what their free cash flow actually was looking like. In these most recent couple quarters, you'll notice free cash flow just turned positive. So, based on the free cash flow turning around, I suspect this company will have no problem making the payments necessary to deleverage as long as the trend in recovery of total vehicles sold continues. You see that their revenue has started to recover here, which is what has caused their free cash flow to also recover, now turning positive. And I mentioned before that they had significant cost cuttings of over $200 million a year that they permanently took out of the business, which will drive them to be profitable at lower revenue levels. And you notice that right here. They're at a significantly lower revenue than they were during their most profitable period in around 2016, yet they have started to turn free cash flow positive. All that bodes really well for this company. So let's look at the trend that's going on with the increase in total vehicles sold. This chart from the Federal Reserve economic data shows the cyclical nature of the total vehicles sold, having a downturn in the early 80s before having a steady rise. And just you can see the undulations and the cyclicality of this industry, recently having its downturn in 2020 and having a rebound starting right here. And I suspect, just as in all these past recoveries, as soon as things have started to turn back up, they recover for quite a long time. I expect the same thing to happen here. And I don't just think that because of this past nature of this chart right here. Let's take a look at the total sales that are happening in 2024. This blue indicates what sales are occurring each month for total unit auto sales. And you can see each month so far this year, we have sold more vehicles than the last year, except April, and all the other months are pretty significantly above the last and are all above their 2022 unit of vehicles sold. This bodes really well for the car industry as more and more units are sold. And keep in mind, Cooper Standard doesn't actually care how profitable these vehicles are sold. They just care that units are moved, regardless of if prices need to be cut. They just need units moved because they're selling to the manufacturers and are not necessarily worrying if the manufacturers have to cut prices to move the units at all. Another big piece that I really thought sealed the deal here was the number of licensed drivers in the US. Just like any market, you want to look at how much demand is there going to be for this product, whatever it might be. And a great indication of that is how many people have licenses in the US. Those are going to be the people that are buying vehicles. So let's go back all the way to 2009. And you guys can see from 2009 to 2011, there was some growth. And then it really stagnated from 2011 to 2012, where it actually went down, and 2013, where it rose only a tiny bit. So it had some stagnation there before it resumed again, going from 2013, 2014 growth, 2015 growth, 2016 growth, 2017 growth, 2018 growth, and now again, 2019 to 2020, almost no growth. And then it started to resume again. And if you guys remember correctly, Cooper Standard's high price was around this 2018 level, just before the number of licensed drivers in the country started to flatline for a couple years. Now, after 2020, you guys can see 2021, an additional 4 million licensed drivers, some growth to 2022, 3 million added. The next year, another 3 million, and then again projected in 2025, adding an additional 3 million drivers to the market. These people are going to be looking to get vehicles. Another piece to keep in mind that I don't have a chart for to share here, but is millennials right now are going into the prime spending years of their life between the ages of 30 and 40. Around there are often the prime spending years where they're going to be purchasing homes, purchasing vehicles, and making big things that drive growth for companies like Cooper Standard. This tells me overall, I expect this trend right here to continue recovering as more total vehicles are sold in the US. And this is going to be great in allowing Cooper Standard to return to this growing revenue, just like we saw over here, where they had growing revenue until around 2018, late 2017, where again, this is where the number of drivers started to flatline. And for about 2 years, there was no growth. There were no more licensed drivers entering the market. And that meant a big deal for Cooper Standard. And now we're seeing the exact opposite. And I expect this trend to continue, especially if interest rates come down. And that could be a great catalyst here. Anytime you have some increase in revenue, that is going to be magnified in free cash flow. And it's going to increase by significant margins. And on top of that, guys, I mentioned the savings that we have up here. They were able to cut out 130% of their peak free cash flow worth of costs out of their business in the last 3 years. That is phenomenal for this company. So let's continue on from here. After you've seen this trend is going to continue, there's also another piece of very good news. So along with that trend, there was some great information with their most recent earnings call regarding their deal with Nike and their use of Cooper Standard's formula for the material Fortrex to use in their shoes. This is what the CEO had to say. The simplest way for me to describe this deal is Nike asked for us to put together a deal that would allow them to go faster in developing products across their portfolio. We've had royalty streams set up based on their volume, so as their volume goes up over a period of time, that's how we get paid. Analyst asked a question. It's just a straight 100% margin cash flow business? CEO said, that's correct. Yes, we've got no investment. So what's going on here, guys, is Cooper Standard developed this material, Fortrex, that Nike thought would make their shoes better. They were able to develop higher quality shoes, and Cooper Standard essentially is lending them the rights to use their formula for this material to put it in their shoes. Cooper Standard had already developed it. There was absolutely nothing they had to do other than say, Nike, yes, we will let you use it. And it's 100% straight profit for them. So this is a little cherry on top. I'm not sure how much revenue will be driven from this area, but any amount that it is 100% profit for this company. They have absolutely no investment here. So you guys can see why I really like this company right now. And you guys are going to see here in just a second that it actually probably looks a little bit better than you're thinking right now. In summary, the current trend of increasing automotive sales will be the main driver of return to normal, but the cost cuts and the Nike deal, which is 100% profit, will help. The company just generated $62 million in free cash flow in 1 quarter in Q4 2023 and looks to be headed to surpass their peak free cash flow of $200 million in the coming years. This is a very cyclical business that I don't want to own long term, but will happily ride in the recovery. It has some fantastic management with great focus on efficiency, cost cutting, generating cash, and deleveraging. Taking a look below, their stock chart tells probably a story of one of the most intense crashes that you will see of a company doing $3 billion a year in revenue. They had a peak per share price of around $140, and at their lowest actually collapsed down below $4 a share. They currently sit at around $12 a share right now. And this is why I really like this company. Not only is it a high quality company, but it is a fantastic price. They just generated $62 million in free cash flow in 1 quarter. And that means if they continue that, they're going to generate $40 million more than their peak free cash flow just based on that. And they are still far below their peak revenues of 2018 and I think that they could have a lot of room to run here. So when I look at valuation and my goals that I have for this company here, for their fair value in 2029, if they have 0% share growth and get a 12 times price to free cash flow, with 2029 free cash flow sitting at $226 million, their per share price could sit around $157. This means we have more than a 10x from their current share price of around 12. Their full value, I give them a price to free cash flow of 15 times, with terminal free cash flow sitting at $283 million. That puts their per share price at $246. And remember, guys, this is me throwing out numbers just so that way I have an idea of where I want to exit. I am not predicting down to the decimal where I expect things to go. It just gives me a reasonable idea to pinpoint where I want to exit for an investment. So I'm going to be looking for the country to continue to sell more vehicles and for Cooper Standard to benefit. The only assumptions that I really have to make here is that there is a recovery in automotive sales and they deleverage the balance sheet somewhat. I think that they have a very, very bright future, and I hope that you guys can see why. If you have any questions on how I came to this conclusion or anything that you felt like that was left out that would be helpful here, let me know, and I will be happy to share that with you guys. This will be the end of our review of Cooper Standard, and from here we're going to move on to answering questions as well as giving a little bit of wisdom coming from Warren Buffett that I think will be really helpful for your investing future. So if you want to stick around, love to have you. First off, in the Berkshire 1993 letter, here's a quote that I pulled from there that I think will be just a very useful piece of advice for any point in your investment journey. In that letter, he said, "The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which the investor thinks about a business and the comfort levels he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk using dictionary terms as the possibility of loss or injury. A business that must deal with fast-moving technology is not going to lend itself to reliable evaluations of long-term economics. Did we foresee 30 years ago what would transpire in the television manufacturer or computing industries? Of course not. Nor did most of the investors and corporate managers who enthusiastically entered those industries. Why then should Charlie and I now think that we can predict the future of other rapidly evolving businesses? We'll stick instead with the easy cases. Why search for a needle buried in a haystack when one is sitting in plain sight?" This first quote is one that I really like and try to cater all of my investing decisions around. Many times it is taught that we should have serious diversification in our portfolios, when in reality, it makes the most sense to invest into companies where you can understand and have a comfort level about its economic characteristics before you buy into it. In other words, do you understand the business and its industry? Do you understand what future it may have? Does it have potential to be completely disrupted by technology in just a few years? For many industries, that answer is yes right now. So look into that before you make any purchases. The next quote that I wanted to get into was from their 1994 letter, where Warren now says, "Understanding intrinsic value is as important for managers as it is for investors. When managers are making capital allocation decisions, including decisions to repurchase shares, it's vital that they act in a way that increases per share intrinsic value and avoid moves that decrease it. This principle may seem obvious, but we constantly see it violated, and when miscalculations occur, shareholders are hurt. At Berkshire, our managers will continue to earn extraordinary returns from what appears to be ordinary businesses. As a first step, these managers will look for ways to deploy their earnings advantageously in their business. What's left, they will send to Charlie and me." This is a very important quote when it comes to looking into how managers are allocating capital in their businesses. You want to make sure that they are doing what is most beneficial for the business overall. Oftentimes, and right now, it is extremely sexy to be buying back shares when it actually doesn't make sense if you look at what kind of return that's generating for the shareholder. That cash may be far better used as a dividend or just redeploying it within the business. They might have great opportunities to invest in new avenues for growth, but instead they're doing what they feel the market will be best instead of what's actually best for the business. And this is really important to understand. So from now, we're going to move on to answering questions from last week's video. And I had a few specifically on Daqo New Energy. You guys can see these questions here. They had specifically concerns about its long downward spiral and U.S. sanctions against clean energy coming from China. So I wanted to give you guys a brief update as this company actually continued today, I believe, hit another 52-week low. And you guys will see that its 1 month performance, it was hit pretty hard. So I thought it would be helpful to give a little bit of an update of what's going on here this week. So first off, let's take a look at what's going on with polysilicon prices. And specifically, we're going to be taking a look. This red line right here indicates what China's per kilogram price looks like. And you can see it continued to slump this year. This was December 2023, and it continued to slump the beginning of this year, whereas other places around the world held up fairly well, I would say. Let's take a look at what Daqo's average selling price actually looked like during this time, and I'm going to show you guys why this is actually relevant to understand. Polysilicon, their average selling price in Q4 of 2023 sat at a $7.97 per kilogram. So when we look at this, it lets us know the average selling price actually seems to be slightly lower than that of China, and that's because they're one of the lowest cost producers in the country, so they can afford to sell at lower prices. And because their price most matches China, that probably lets you know most of their sales are not coming from either the US, which sits at $26, or Europe, which sat at just under 17. And I'm not just saying this, let's look at some other important information as well. This is an article from 2021 when the US banned import of solar panel material from Chinese companies. Biden administration on Wednesday ordered a ban on U.S. imports of key solar panel material from Chinese-based Hoshin Silicon industry. The 3 other companies added to the U.S. blacklist included Daqo New Energy. This is from 2021. This has not since changed, meaning Daqo New Energy actually is unable to sell directly to the U.S. at all. And this has been the case for now 3 years. In fact, 3 years very close to on the dot since June 24th. That same year, Daqo was asked what impact the U.S. sanctions would have on their sales. CAO said, the U.S. makes up less than 10% of our downstream clients' solar panel markets. The International Renewable Agency says the world added about 127 gigawatts of solar capacity in 2020. Of this, only 12% was in the U.S. In 2023, the U.S. added 26 gigawatts of solar, while the world added 447, meaning the U.S. makes up less than 6% of the world's solar panel growth. So to come back to this question, overall, everything points to Daqo New Energy making almost all of their sales in China itself and to a few surrounding companies. These sanctions from the U.S. on China are almost going to be a non-factor in this company and being able to sell going forward. If you guys have any questions on this, let me know. Go watch that previous video on Daqo New Energy where, yes, I pronounced the company wrong the entire video, but that's fine. I am a human too. But go and check that out, and that will give you guys a lot more energy about why this is important to understand and other pieces that makes this company, in my opinion, a very good buy. But keep in mind here, this is a buy that is based on the price of a commodity. Commodities often drop more and for longer than you expect, as is the case with my purchase being many months ago, and it continued to falling to 52-week lows. I believe I'm actually down around 40% on my position, but that's okay. This is a little bit of a longer term play, waiting for this spike to occur again, and I am happy, at least for now, none of the fundamental assumptions that I've had to make have changed, so I will continue to hold my position here. Moving on to the next question. I was asked to look at ATKR, ticker symbol ATKR, and this company was actually very interesting the more I dove into it. This company operates very broadly in the electrical supplies industry, supplying different important building materials for commercial and a little bit residential, but mostly commercial. Their competitor averaged revenue cumulative average growth rate of about 6.6%, free cash flow margin of about 6.5%, ROIC of 11, and ROE of 13.3%. This company, ATKR, averaged revenue growth of 8.2%, free cash flow margin of 9.6%, ROIC of 19.3%, and ROE of 51.7%. So you can see on every front, they beat their competitors by a wide margin. And keep in mind, this is actually the average of, I believe, 7 competitors in their market. So they far exceed what the average is in their industry. And it made it really interesting for me to dive into this company, but I did find some things that I didn't really love, although I don't think this would keep me from taking a position in this company. Currently, they're issuing a dividend for some of the first quarters in their history when they have great ROIC. To me, this doesn't make a whole lot of sense, for the same reason that this quote above from Berkshire's 1994 is laid out. Managers should look for ways to make great capital allocation decisions, including when to repurchase shares or issue dividends, and that's the other big piece for this company. They retain very little cash and instead you must use almost all of it to buy back shares. This company seems to have proven over many years that their managers are very good at buying out competitors, but yet they're pretty much giving away all their cash now in the form of buybacks and dividends. I didn't really love to see that for right now. In my mind, it would make more sense for the company to stockpile cash and buy out more competitors. As I noticed a theme, many competitor stocks are down, so it might be a pessimistic time to be able to step in and buy out competitors, gain more market share. They've proven they know how to do that. Now, there could be that there's no attractive opportunities right now, but still in my mind, I think that they might be a little bit better served doing this. Overall, even though I'm giving this company a little bit of a hard time for how they're managing their cash right now and their capital, they are a very high quality company from everything that I could tell. They would still need more work before I'd be willing to enter a position, but at the time for me, they're not quite low enough to be attractive to take a position at this point. I am already pretty much maxed out with what I can do, and I am very excited for my future in the investments that I have, and we're going to be talking about those and how they performed over the last month here in just a second. Moving on to the month in review and how my stocks performed during this month of June. And I got to tell you guys, things weren't pretty. This is the list of companies that I currently own in order of largest to smallest holdings. My largest holding is Alibaba, so on and so forth. You guys can see this month Alibaba was down 6.1%. Many others were down significantly. Daqo New Energy down 35%. My best returning stock was the company with continually amazing news, Boeing. Right, you guys, you probably would have never guessed that this month of June, despite all the negative headlines, Boeing was actually the best performer in my portfolio as far as stocks go. When it comes to the options, you guys can see the TLT call was actually up almost 34%. FXI call was down about 19%. And I had one quick SQQQ call that actually I ended up closing after a 54% return in quite literally just 2 days. I just saw a little bit of dislocation with the market rising a little bit quicker than I think it should have. And I will only take those type of positions in the most extreme scenarios. Probably won't be taking anything like that again unless we see a crazy meteoric rise. So propped up a little bit by the returns from some of my options plays. Hopefully we can see a good rise in bonds, some drop in rates, and can exit that. That one has gotten very close to hitting my target here several times now. So I hope it can get there. It's pretty close. For the total portfolio, I was down about 7.7% in June, while the S&P 500 was up about 3.47%. You guys said that a monthly review would be a little bit better, so hopefully this helps. Let me know if you guys like this or if it's not helpful at all. Just wanted to share them, and you guys will get a little bit more specific information on what options and things that I own. I've purchased these a little bit longer dated TLT and FXI many months ago, so they've been in my portfolio for several months now, and I'm excited to hopefully get some great returns out of them. Last piece, we're going to be going into just some quick news. Some news from Bloomberg. It's time to be bullish on Britain. Sentiment is really turning around here, and I'm excited. This is going to affect GXO as companies start to restock. That'll be a great trend for them. Some news for Alibaba. Taobao and Tmall's 2024 618 campaign scores brand and loyalty program wins. 365 brands on Tmall topped 100 million RMB in gross merchandise value. 36,000 brands doubled their gross merchandise value. And their VIP loyalty program new members add 65% year over year to reach record highs. Guys, when you look at the business underneath the stock price, things just keep looking better and better. Another piece on that, Chinese e-commerce sales up 14% during the 618 shopping festival. E-commerce firms, including Alibaba and JD, saw gross merchandise volume rise during the mid-year event. So some great news here for Alibaba, and I expect to see that starting to be reflected in coming quarters. Last piece of news, Beijing intervenes in China's solar industry as overcapacity dries up profit. This is the main story around Daqo New Energy, and this is what I'm going to end up leaving you guys with today. This will be something to pay attention to in coming months. We want to make sure that China allows companies to go bankrupt in this industry. And I say that because we want supply to fall out of the market as demand stays steady or rises. Daqo New Energy has an incredibly strong balance sheet, and it's going to allow them to weather the storm. And the worse the storm gets, that means there are few competitors left standing after it ends. And that's exactly what I'm looking for here. So hopefully that continues. We don't want to see China put any price floor in, as that would prop up these companies that are currently losing a lot of money. So pay attention to that. As of right now, no fundamental changes have been made to my thesis, but we got to keep an eye on this going forward. So with that, guys, I really thank you for being here. Again, throw any questions you have down below, and I will be happy to answer them. We will see you guys in the next one.